Good day and welcome to the Binary Institute's Introduction to Binary Options course, Lesson 3, Market Analysis. Today during our lesson, we're going to take you step by step through the trading analysis process by starting off by discussing trading times, followed by 3 different schools of thought that will help you understand the price movement in the market. Now, as you can see, we have a lot to go over, so let's dive straight in. Now, one fantastic element about retail trading is that you can essentially trade 24 hours a day, 6 days a week. In addition, we can essentially trade in markets all across the world, whether we're trading stocks, currencies, indices, or commodities, as long as that specific market is open. Now, some of the major markets around the world are Japan, the UK, and the US, which span across several time zones. Now, it's important to keep in mind that not every single market is open 24 hours a day, 6 days a week. Each country's market is typically open anywhere between 8 a.m. to 5 p.m., 5 days a week, depending on the country. In most parts of the world, that would be from Monday through Friday. However, many Middle Eastern markets are open on Sunday until Thursday. Now keep in mind, while it's 9:30 a.m. in Tokyo, it's actually 1:30 a.m. in London and 8:30 p.m. in New York the day before. Essentially, this means that when the markets are open in Japan, the markets in London and New York are closed. When the London market opens at 8 a.m. on Monday, the Japanese markets have already been closed for an hour, and the American markets won't even open for another 6 hours. Now, just because there are markets that are open 24 hours a day, 6 days a week, it doesn't mean that we should trade all of the time. There are times when the market is quieter and other times when there's great volatility. Now, if you listen to any financial news or follow any economic news sites, you will often hear about different trading sessions and their importance. The 3 sessions are the Asian session, the European session, and the American session. Now, the first session to open the day is the Asian session, which includes countries such as Japan, Singapore, China, Australia, and New Zealand. This is the very first session of the day based upon time zones, and this is the first price movement that we will see in the markets. The next major session of the day is the European session, which just begins towards the end of the Asian session. And the European session includes major markets such as the UK market, Germany, France, and Spain. The final session of the day is the North American session, which is considered to be the biggest trading session of the day. If you look at it, 85% of all currency trades include the US dollar, so we're going to be focusing primarily on the US dollar-based events, but also Canadian dollar events as well. During the early morning hours of the North American session, we can see a great deal of U.S. economic data will be reported, which will provide many trading opportunities. Aside from that, there's enough liquidity in the market to focus strictly on technical price movement. So, let's take a look at the best times to trade. Now, generally speaking, the best times to trade are going to be between when the London market's opening time at around 8 o'clock a.m. GMT time until the U.S. market's closing time, which is around 10 p.m. GMT time. Now, the peak market hours are during the European session and the North American session's overlap, which is between 1 o'clock p.m. GMT time and 4 o'clock p.m. GMT time. Now, these are the most liquid hours, which is when most traders are active and trading. It's also important to keep in mind that there are other times that are not ideal for trading. Typically speaking, we consider the weekends and holidays as times to step away from the markets and relax. There won't be very much market action anyway. Also, any time that there are major sporting events or cultural events like the Super Bowl or the Eurovision finals, the markets will typically be a bit quieter than normal. Now, aside from knowing when to trade, it's important for us to know how to trade. And this is come to something known as market analysis. Now, when we analyze the markets, we are essentially focusing on three different schools of thought. First, we have fundamental analysis, followed by technical analysis, and then sentiment analysis. Each form of analysis is equally important, and a basic understanding of each of them can lead you down the path of being a successful trader. While some traders will tell you they solely rely on fundamental analysis, others might choose to focus solely on technical analysis. While technical analysis and fundamental analysis are extremely important, there are some traders who use sentiment analysis, and they have the results to prove its success. That being said, most successful traders will tell you that they use a mix of the three, rather than relying solely on one form of analysis. Now, we would agree with those traders here at the Binary Institute, and we will focus over the next lessons on giving you the skills, teaching you how to reach your trading potential. As you begin to trade, you will find the best form of analysis that works best for you and what you understand best. Now, we'll start by taking a look at fundamental analysis. Now, fundamental analysis essentially answers the question to why the price is moving the way it is in the markets. And most importantly, it's going to help us anticipate future price movement. In basic terms, fundamental analysis allows us to look at different events happening around the world at any given time and understand the effect of those events on the price of a specific asset. All of the price movements that we see in the market are influenced by a variety of events around the world that occur on a daily basis. These events give us an indication of how healthy or unhealthy an economy is, or how strong or weak a particular market is in the short term, but also in the long term. We try to study these events in order to understand what their effect will be on the value of the asset. Now, when we say events, we're referring to a variety of reports or data, speeches, and press conferences that can affect the price of an asset, whether it be a currency, a stock, an index, or a commodity. If we're talking about data that's being published, we can look at employment reports, retail sales data, interest rate decisions, or manufacturing data. Speeches by major financial figures also fall under the umbrella of fundamental analysis. Whenever the head of a central bank, such as the Bank of England, the U.S. Federal Reserve Bank, the European Central Bank, or the Bank of Japan, for example, give a speech, investors will often look very closely to see if there are any hints about how the economy is faring in the short term, but also if there are any hints about future changes in monetary policy. Now, all of this is important to us as traders because we follow the markets, and the market will react to the data that these reports show. Many traders will actually trade when these fundamental events occur, depending on the result, in order to make the biggest profits. Now, another form of analysis that we have when we're trading is technical analysis. Technical analysis is the study of historic price movement in the markets by using a variety of charts that measure different aspects of the price movement. Now, we refer to these charts as technical indicators, and they show us patterns of how the price has moved in the past, which will help us decide when to enter the market in the future. Now, what's important to keep in mind is that when we use technical analysis, we're trying to understand how the price is moving in the market in the current moment, but more importantly, how the price has moved in the periods before. There's a popular saying, history tends to repeat itself, and that couldn't be truer for financial markets. The price movement in the market typically moves in patterns. As the price reaches a certain level on a specific chart or moves in a certain way, we can predict how the price could move in the future. And this is exactly what we're doing when we're using technical analysis. We're attempting to predict how the price could move in the short and long term. Now, each of the technical indicators that we use measures a different aspect of the price movement. Some indicators measure volatility, or how fast the price is moving in a certain direction, while others measure how much momentum is behind the price movement. Some indicators measure whether the price is perceived to be overbought or oversold, while other indicators actually show us the direction of the price movement. While each indicator might only give us one piece of information to the puzzle, when we combine a variety of indicators, we have a better understanding of the overall price movement in the market. Now, to new traders, we usually give this example. Imagine that you're standing in a park, and you look out across the park to see what lays in front of you, and you feel that you have a good understanding of what the park looks like. So you decide to take a picture of the park with your camera phone. Now, the very next day, you're in a plane, and you fly over the very same park. You look down and you notice how different the park looks from above. You see different aspects of the park that you couldn't see from the ground. So you take a picture of the park from above. Now, when you take those two pictures and you put them side by side, you have a more complete understanding of what the park actually looks like. And this is exactly what we're doing with technical analysis. We're looking at the price movement from a few different aspects to understand as much as possible about the price movement before we invest in a trade. Now, the last form of analysis that we have is sentiment analysis. In general terms, sentiment analysis relies on the individual trader's feelings or sentiments. If each trader followed the markets by using technical and fundamental analysis alone, the markets would cease to function. All traders would trade in the same direction and we all would be millionaires. The fact of the matter is, no matter how many indicators we use or how aware we are of the fundamental environment of a particular asset, there are times that we still will trade in a certain way without any particular explanation. Sometimes we will just have a gut feeling that the market's going to react in a certain way. Now, sentiment analysis is extremely important, but it's not a form of analysis that we can necessarily study. Sentiment analysis is highly individual and is based on your personal trading experience. The more we learn about the market and understand about the price movement, the more opinions we will have about potential price movement in the future. Now, as we said earlier, most traders will use a mix of technical, fundamental, and sentiment analysis whenever trading. Now, as our course proceeds, we're going to take a deeper look at technical and fundamental analysis so that you can begin to utilize each of these individual skills and start profiting from the markets on your own. Until our next lesson, have a great day.